Okay, apologize for the slight technical glitch over there. Okay, so back to our daily chart on SPY. So you can see that overall S&P 500 has been on a very strong uptrend since the start of 2019. And for those of you who have, for those of you who has watched my videos, you know that strong uptrend. We know that the chart is on a strong uptrend when we have the 50 above the 150 moving at simple moving average. And then currently, this is where we are at now on 2020. And we see that the S&P 500 has shown a dip over at the 50-day moving average once over here. And currently, it is in the midst of a potentially what I would call a potential correction. And it has currently reached the 20-day exponential moving average. So for those of you who are unfamiliar, the red dotted line over here, this is the 20-day moving exponential moving average, which is the 20 EMA. The 40 EMA, the 50-day simple moving average, 100-day simple moving average, or the SMA in short, the 150 SMA and the 200 SMA. So given the current situation, what I would hope, personally for me, I would hope that the S&P 500 can correct further down and hit the 50-day moving average again. So after a strong uptrend, we will always want the we would like to see the market have a healthy correction, and this correction and as well as the volatility in the market should be welcomed by both investors and traders together. So this volatility will allow us to accumulate our core positions as an investor at a lower price, and if you know how to identify fundamentally strong companies as well as companies that are at a fair value or undervalue, this could be a very good time for you to add on to your shares and positions as well. And as for trader, from a trading perspective, you'll be able to take a long swing trade upwards, provided that the stocks or the broad market can show that it can rebound after hitting the 50-day moving average here and continue up into an uptrend. So give me a moment while I get my drawing tools ready. So personally, how have I taken advantage of this situation and the increased volatility that we have over here? Now, if I go on over to the SPX, which is the index that tracks the S&P 500, that tracks the top 500 companies. What we are looking previously is the SPY, which is the ETF that represents the index. So you can't buy the index itself, which is the SPX, and you want to invest in the index, you have to go through the ETF that tracks the index. So personally, what I'm doing, I've been doing a strategy from I've been doing this strategy, what I would call as a profit castle strategy. So basically, what I'm doing here is that I'm betting on SPY falling into the range of these values. Okay, let's go back to the chart. I'm betting on the probability of SPX, the index, falling in between the range of this gray box over here. And so do I how do I structure my trade? I make use of calendar spreads. So these are options, advanced option strategies, which I will be covering in my channel in the near future. So keep a lookout if you're interested in learning how to use options to increase your to maximize your profits as a trader, and also for investors, options can also be a way for you to protect your profits and also hedge against downtrends like these, like the ones that we have over here. So basically, back to how I will structure my trade is that I'll do 3 calendar spreads that's being placed at 3 different areas, at 3 key areas where I would think that the SPX itself is most likely to reach towards the end of February. So from here, for those of you who understand options, you can see that my 3 calendar spreads are structured as such. I sell a short dated option contract, and I long a long dated option contract. So, and then these are spread out into 3 prices, one at 3270, one at 3380, and one at 3330. So these will correspond to what you see over here in the risk profile chart, the profit and loss chart. On the y-axis over here, we have the profit and loss, the P&L, and this is the zero line. So anything above this zero line is profit, and anything below this zero line are the losses. And here we have the price range. So you can see the SPX currently right now it is off. It is after market hours, and we can see that it is at 3337.75, which is at this line right here. And right now you can see 2 lines on the chart. So the red line over here is my profit and loss at expiration. So when my contract expires, this will be the maximum profit that I will be getting, provided that the SPX stay between this range over here. So if I go to set slices and I go to break even at expiration, February 29, I'll be able to see the strike price where I will get my max, where I will break even. And these prices are at 3,226 points and 3,412 points. So as long as SPX fall within these 2 range boundaries, by the end of February, I'll be getting a maximum profit of, you can see here, 1,591 over here, $1,500, $1,006 if it falls into the 3,300 range, and $1,100 if it falls into the range of 3,381. And currently, right now, if you were to expire, let's say the SPY doesn't move anywhere, and it expires exactly at this price right now, I'll be getting $1,257. So when will I lose? I'll lose when SPY when we go into the last week of February, suddenly SPY encounter a huge bull run, a huge recovery upwards. So if you can rebound very strongly and go up very strongly here, and by the end of February, which is the end of this gray box over here, it can shoot above this top boundary of my gray box. There is one scenario where I will lose my trade. Another situation is when Monday the market opened and SPX, the broad US market experienced a heavy sell down, and it sell down all the way down to below the 50-day moving average and below my gray box by the end of February. There's also another situation where I will encounter a loss for this trade. But as a trader, you have to manage your risk. You have to manage your risk properly. So anytime where I were to if I were to see my trade going out, falling out of my profit range, I'll just close it and take it as a break-even trade. So essentially, this trade for me right now is a risk-free trade. Of course, this trade has been placed quite some time ago during the mid February, the second week of February. So back then, the risk encountered will be much higher. And since right now 2 weeks have passed and the SPX has been bouncing in between my profit zone. So currently my position right now is risk free. And for those of you who are wondering how do I actually place these peaks? How do I select this price range of 3,200, 3,300, and 3,380? So for this, I make use of this tool called the Fibonacci retracement and Fibonacci and extensions. So these are all advanced analyzing techniques I will be slowly going through over them in my channel in the future. So again, please stay tuned, subscribe if you haven't done so, and and keep a lookout for this exciting content to be released. So how do I use Fibonacci retracement to help me determine my profit levels? So these peaks are also known as the jackpot, the profit jackpot that you can realize after the options have expired. And to determine these levels, I first use the Fibonacci extensions. So for Fibonacci extension, you want to connect a low of a wave to the high of the wave, and from the high of the wave to a low of the wave.我讲话很大声吗？很大声啊，大家讲话小声一点。没有 chat 的啊，so sad。Hello, hello. Test, test. Is everything okay? Okay, so back to where I was. So if you were to connect the low of a the low of a wave, the impulse wave, the low of an impulse wave to the high of the impulse wave, which is the uptrending wave, and then connect the high of uptrending wave to the low of the corrective wave, this downward correction, we call it the corrective wave. And then you have all these extensions as shown over here. So for this, I will not go into the details of how these levels are being calculated, but basically what it says is that there is a strong tendency for the stock when it is going upwards, when it is going experiencing the impulsive wave this time round. These levels, the 23.6%, the 32.8%, the 50%, 61.8%, as well as the 100%, these are what we call the Fibonacci levels. So these will have a tendency to act as a strong resistance that will be stopping the impulsive wave from going further. And you can see that these levels have acted pretty well in this for this impulsive wave right here. And you can see that it is being resisted by the 61.8% level. So of course, always remember that when we talk about technical analysis, it is all about probability. There is definitely a chance for the market to continue upwards, ignoring this 61.8 resistance level. And if it does, the next resistance level will be at 100%. And if I were to scale this, if I were to scale the chart up a little bit, you'll be able to see the 61.8 level and the 161.8 level, and as well as the 261.8 level. So these are too far away for our concern. So therefore, even for to me, the 100% level is a bit too overstretched. And I feel that in when I place this trade on the second week of February, I think that it is highly unlikely for the market SPX to have experienced such a huge uptrending potential and hit the 100% by the end of February, and which is what prompted me to structure one of my jackpot profit levels, the profit castle, as it looks like a sandcastle from the risk profile chart previously. One of the peaks, I placed it at the 61.8 level, as you can see over here. So these three lines marked out are my peaks from the risk profile chart previously. So that was my first profit level. And as you can see, how do I determine my second and third profit level? These are then for the next two levels, I do not really look at the Fibonacci extensions so much anymore. This time, I place them on strong technical supports. And what are strong technical supports? The moving averages. So you can see that I placed my second profit level, the peak of the the peak of the profit at somewhere around the 20-day exponential moving average. Of course, when I was placing the trade, which is at this point over here, the 20 EMA is only at this level. So some estimation and prediction based on your own judgment will be required for this. And then lastly, my third profit level is placed at somewhere around the 20 EMA as well as the 50 SMA. So if you are in doubt on how to determine the second two profit levels, another way that I will commonly use is that I'll place them at equidistance apart. So in this way, if you do this, you have a you have a graph, you have a risk profile that looks something like this, and it will cover you, and the profits will cover you a pretty wide price range in the S&P 5 in the SPX market. But of course, if you want to cover yourself with a wide price range, then the profit levels will be slightly lower as well. If I were to compress these three, if I were to compress these three peaks together, what I'll have, let's say instead of placing them so far apart, what I'll have, and if I were to place them narrower now, you can expect the chart to look something like this. So this may be what the chart would be looking, the risk profile would look like if I were to place the the peaks closer. So instead of 3270, I could maybe place it at 3000, maybe 3300 instead, and 3330 I could have placed it at 3350, something like that. Yeah. So this is just a rough example. Of course, the the in-depth strategy will be covered at a much later time. All right, so this is what I have for the general market and what I've been doing. And as you can see from my portfolio, because of largely because of the three SPX calendar spreads that I have, that you can see over here, I managed to close the day. I managed to close Friday at a profit while the general market has been going downwards. So you can see that from the three SPX calendar spreads over here, they have been giving me quite a handsome profit already. And if SPX could hold its range between the gray box, between these gray box, then you can expect the profit to reach levels like 1500, 1600, and 1200. And at the low range, 800 or maybe 960. Yes. Okay, so going into the last week of February, what kind of trading and investing ideas do I have for you guys? So first up, one of my community members has pointed out to me that Intel is currently undervalued right now. So going according to our value investing strategy, if you were to apply Intel through the 6 steps, the 5 fundamental steps, that is the increasing business profitability, the double-digit positive growth rate, competitive advantage, a high ROE, as well as a reasonable debt, Intel passed them reasonably well. And what's more, Intel right now is at an Intel has an intrinsic value of about 80 over dollars. So I'll leave the calculation to you guys. So from what I have, the intrinsic value is over 80 over dollars. And from this, we can see that the current price of Intel is only at 64.34. And this means that Intel is a fundamentally strong company with a huge upside potential of perhaps over 20 to 30 over percent. Now, what's more, I have previously analyzed the chart of Intel for you, and you can see that these are the potentially strong horizontal support and resistances. One of them at $30, $37. These are levels where the stock would highly unlikely to come back down to visit again unless we experience a huge bear market or some strong negative news for Intel for some reasons. Okay, the more relevant levels for us will be at the $50 level as well as the $57 level. And you can see that Intel has been in somewhat of consolidation between the $57 and $43 since 2018. And it has continued for 2 years before it showed a breakout, come back down to retest it, and then continue a strong breakout afterwards. Now, what I have not analyzed yet is, are there any any uptrending trend line support for Intel? Now let's take a look. If we were to connect the lows from here, this seems like a potential trend line, but for some reason it kinda too steep for comfort. So the gradient of a trend line will determine the strength of the uptrend. And generally what we would like to see is a uptrending trend line that's at a degree of 45, at an angle of 45 degree. So this would be most comfortable for me. So any steeper than that would tell me that the trend is too strong and unlikely to sustain for an extended period of time. And if it is too gentle, then it signals to me that the uptrend may be weak and unlikely to hold on for an extended period of time as well. And you can see that for this trend line, it somehow seems rather steep to me. But if it were to work, if it is to be respected by the wide market participants out there, then an opportunity might surface rather soon. So we can see that Intel has been in a mini consolidation that's around here. Let's use the chart tools instead. A mini consolidation around here. Oops. Okay. My bad, my bad. Yes, so it is in some of a mini consolidation at around this level, but it is too small for us to use it for our trading purposes. But if Intel will be able to show a rebound over here, or better still come back down to test the 50-day moving average support, this could be a rather good time for you to add it, to include it as your long-term value investing portfolio if you were to believe in Intel. And also as a trader, you might be able to structure some long swing trades as it shows a rebound over here and go up and bounce off back into the impulsive uptrends afterwards. And as for earnings, something that we want to avoid as traders, it is rather far away, so it is none of our concern at this point in time. So what about resistances? I think if you were to draw a resistance, it will be somewhat like that. Do you think this is a good trend line? Maybe not, right? Because it has been breached rather pretty badly over here. But let's just keep it here for reference sake. Okay, so if you guys have any question, feel free to ask me. Feel free to type it in the chat so that at least we have a more interactive session over here and not just myself talking all the time. So, any one of you interested in having a rough analysis of Intel using our investing strategy, or you would like to analyze it yourself and you think that you are confident enough to look at it yourself? I think there's some kind of delay in. Okay, silent means I'll take it as a no for answer and I'll just move on to our next trading insights. So next up, so this is Intel. Next up is something that which is something that I've presented to you guys already, and that is RCL. So RCL, if you have already watched my videos, you know that it is currently in a consolidation phase. And previously, when I presented the stock to you guys, it was at this convergence of the moving average level. And shortly afterwards, it experienced further correction. Now it is currently at $106. So I hope most of you have not taken your position into RCL yet. If you have, then just continue holding on if you believe that it is a strong company. And according to the investing strategy, it should be a rather strong company, if not for the relatively high level of debts that it holds. So as for those of you who have not invested yet, your chance may be near. So let's hope that RCL could experience a deeper correction back down to a 103 level or the 100 level. And at this point in time, it will be at a strong support that has been tested quite a few times in its history. And as you can see here, it's been tested once, twice, 3 times, and 4 times, this zone over here. And personally myself, I'm quite inclined to take a trading position for RCL. And should it reach this level or this level over here, what I'm looking at right now, what I'm contemplating over right now is also another options trade. I myself right now is more focused on options trading and not so much on stock swinging tradings anymore, because I find that the options, although the leverage is larger, the profit is also larger. So as long as you can know how to manage your risk properly, options serves as quite a attractive tool for you to maximize your trading portfolio. So back to RCL, two trades that I'm contemplating. One of them is a diagonal spread, and the second one is the calendar spread. Calendar spread, you have heard from it already in the SPX analysis. So how would I structure my trade if I were to take them? I'll be looking at a long dated option contract, maybe the 19th June. And for diagonal spread, okay, let's go over the calendar spread first. For calendar spread, I want to sell a call that's at the current strike price. So when it is at a strong support, it will be at about $100. So I want to sell this strike over here, 116. I mean the $100 strike price that's expiring in 19 June. Do I want to sell? Sorry, I want to buy it. You want to buy the long dated option contract, and then you want to sell the short dated option contract. So I'll normally be looking at and date to expiration of about 30 to 40 days, as this period is the time period whereby the time decay of the option the time decay the time value of the option decays the quickest. So when you do advanced option trade, personally I like to do structured my trade in such a way that I'll be benefiting from time decay, and most of my profits will be from time decay as well. So going into the 27 March expiry, I'll again buy a same strike. I'll sell a same strike call at 100, expiring at 27 of March. And what will my trade be looking like? So if I were to sell this, if you're using this platform, just control and click again, and you'll be able to combine the two trade options legs together. And you can see that this trade will cost me $3.20 per share, and each contract, if you are experienced in trading options, you know that each contract stands for 100 shares. So this contract will cost me $320. And when you do option trading, always analyze the trade. Look at your risk profile before executing the trade. So how will I benefit from this? So again, the y-axis over here is the profit and loss, the P&L. Anything above the zero line is the profit. And here we have the price range, the x-axis, the price range. So expiry date will be on the 28th of March. And if the price range of RCL stay within my break-even range, which is around $91 and $109, my profit will be anywhere from $0 to $336, as you can see over here. Just focus your eyes here, and there will be 340 over dollars. So $90 to $110 by the end of March. Where would that be on the charts? So you also would like to go back to the chart to look at the levels and see if there's any strong resistance or support at those levels. So at 91 level, $91 will be over here, and 110, $109 will be somewhere here. So if I were to take this trade, I have up to the end of March for RCL to bounce within these two levels, these two boundaries. And if it stay within these two boundaries, remember that I'll be executing my trade if the stock reaches this level, so it is somewhere at the midpoint. And if it stays within this boundary, my max profit will be $400. Sorry, $340. Yes, for a month. And that is quite good, especially for my account size. That will stand for about 2%. Yeah, for a month, that's not bad. And it only take up $320 of my capital. So there's a 1:1 risk to reward trade. So what happens if the price go down or go above? Two ways. You can either roll the options, roll the short dated options, or you can close the trade completely when your loss reach when your loss reach the when your loss reach anyway, don't let your loss go beyond 20% of the max loss. So $320 is the capital that you have invested in this trade, and this $320 will be the max loss. 100% you will lose it if you let the trade go out of hand. So as a guideline, do not lose more than 20% of this as a safe and conservative risk management strategy. Now, what would I do? This is a diagonal spread. Sorry, this is calendar spread. What would I do if I were to look at a calendar spread in sorry. This is a calendar spread. What would I do if I were to take a diagonal spread instead? These terms are confusing me. So for a diagonal spread, normally you will do a diagonal spread if you believe strongly in a stock and you think that the stock in the long run would go higher up. So ideally, for diagonal strategy, you would like to execute it on fundamentally strong companies that is undervalued. And just nice RCL is one of them. And for diagonal spread, you want to the selling and buying is same. You want to buy a long dated option contract and sell a short dated option contract. But this time, instead of selling it at the same strike price, you want to instead of buying it at the same strike price, you want to buy a strike price that is at a 0.8 delta, so that it will be somewhere around here or here. So perhaps I'll take the $90 strike and I will buy it instead. And as for the selling side, what do we want to do? We no longer want to sell at the same at the $100 strike anymore. What we want to do this time is to sell one or two strike out of the money. So again, bearing in mind that we will be executing this trade if it reach the strong support of 100 over dollars. So one or two strike price will be perhaps at $102 or $103. So let's take $103 and let's sell it. And here you go. This is the trade that I will be taking if I were to do if I were to execute a diagonal spread instead. And what I will have this time is a debit of $12.45 per contract. Multiplied by 100 shares, there will be $1,245 per trade, per contract. And this is also 100% of your max loss. Now let's analyze this trade and look at how it does compared to the calendar spread. Previously, when we look at the calendar spread, it is a neutral strategy. That is to say, you are betting on the price of the stock to neither move up or move down. The best case scenario is that the stock stay in its position at $100, and that is where you achieve your max profit. Now, for a diagonal spread, things are the other way around. For a diagonal spread, you are slightly bullish on the stock. You are betting that the stock would go higher up by the end of your short dated option. So before your short dated option expires, if the stock RCL can move up currently from a price range of $100, go up to about $103, that is where you would make your maximum profit. So the next question is, what happens if it shoots up further than that? Instead of 103, goes up to 110 or 120. Well, you are still in the profit, but slightly lesser this time. So let's say if it goes to $120 at expiration, you'll be looking at a profit range of about $65. Again, focus on the red figure over here. At expiration, 120 or $130, that will be about 65 to $55. And this trade you'll be losing if RCL goes further down after you enter the trade. And from the risk profile, if we choose the break-even point, you see that the break-even point is almost exactly at $100, the point where we will enter the trade. And if it goes any further than that, you will be losing. Your trade will be losing. And the maximum loss, again, remember that it will be at $1,244. So what you would like to do to manage the trade, one way is to close one way again is to close the trade when it so this is 100% max loss. One way to close the trade when it reaches 20% of your max loss. All right. Another way, if you believe that the stock would no longer go down as much, this is a rather risky strategy, by the way. What I would do is to roll down my short dated contract. So you can see that I have for this strategy, I will have sold a $103 call option. If it goes further down than that, I would buy this back at a profit and perhaps sell another one lower at perhaps 100 or 95. So let's say 100 in this case. Generally, I'll still be at a loss, but if you can manage it properly and wait for the stock to rebound and continue rolling your short dated call, you generally be profiting from the time decay. So time decay, as I've been talking about, is the theta. So from my trading portfolio, you can see that I have a theta of $102, 102.4. So what this means is that as each day passes, I'll be earning $100 from my options, from all the options trade that I'm holding currently. So as an advanced option trader, personally, I would like to take time decay into my favor and profit as well as benefit largely from it. Okay, so that's all for RCL. Lastly, I would like to go spend some short minutes on Boeing. As I've covered Boeing in my trendline video, and it is also another stock that's in consolidation and that's constantly being bombarded by negative news of its 737 Max plane, and recently the most recent in the Iran issues. Yeah. So bad news again and again. So something that I would like to add on over here, in addition to the consolidation phase that you are already seeing on the screen right now, is that I have also noticed a downtrending trend line that's happening over here. So maybe you would argue that this would be a better trend line, but let's just put it like this for now. So some of you would have noticed that this is a descending triangle pattern, and should this level not hold, it could break down and go visit the next support level that's at $300. So what do you think is going to happen to Boeing? Personally, my take on Boeing is that the downside potential should have more or less been reached already, considering that this support level that we have seen over here has been tested for so many times already. And given that the bad news has already been that a lot of bad news has already been out, right? So how much more can Boeing take? How much more downside is there to Boeing? So personally, my take on Boeing is that it should likely go continue sideways. And for this, perhaps maybe you could wait for it to anytime that it is showing us signs of a rebound from this 330 level or 321 level, you could take a long swing trade for Boeing. I've not done the analysis for Boeing in terms of the value investing strategy, but from what I would think is that perhaps Boeing would be quite overvalued right now. Yeah. So what else about Boeing do we have? For Boeing, previously I've done a calendar spread, but unfortunately I've done a calendar spread that's around this period at 335. But the sad thing is that it broke down quite sharply and I have to cut my losses at 20% of max loss. So that was a loss for me. And yeah, afterwards I haven't gotten back into the trade already. But perhaps if nothing surface, not if there isn't a better trade opportunity that is surfacing, I could again get into Boeing as a sideways and structure a sideways trade, perhaps something like this, using a diagonal spread. Yeah. So basically that's all for me today. Is there anything that you'd like to know or ask? So this is my trading journal. You can see that this is the SPX calendar spread that I've been talking about previously. I've already done once in January, entering in the first day of January, in fact. And then this is currently how much I've profited from the trade itself, $900 after a month with an initial capital of $400. So this is a 2:1 risk to reward trade. And currently this is the one that I'm holding with the respective strike prices. So all these have been already gone through earlier in the stream. And for this, I'm looking and I'm hoping. Oops. Which broker do I use for option trading? I use this. This is Interactive Brokers. So, yeah, so as you can see over here, Interactive Brokers. So for my trades, not only options, for stocks as well, for my trades, I'm all doing them on Interactive Brokers, mainly because uh, it has better commission as compared to Think or Swim, which I use for my investments. So yeah, but if you are staying in Singapore, one downside of using Interactive Brokers would be that it is not MAS regulated. Yeah, so some caution if you would like to look more into that if you are concerned about the safety of your money. Yeah. And you can see from my other trades, there's like 3690 from the Hong Kong market. You can also do Hong Kong. Interactive Brokers is international. They offer trades from quite a few countries. Singapore as well. If you're a foreigner, you can trade Singapore shares on Interactive Broker. But if you are local Singaporean, then unfortunately you will not be able to do that. So you will have to go through local shares through the local brokers. Yeah. Inactivity fee for Interactive Brokers, they have an inactivity fee of $10. Yes, but if you are an active trader, this $10 is not to be taken in, should not be a concern to you. Yeah, because this inactivity fee, if you have racked up $10 in commissions, then the inactivity fee will be waived. So if you're an active trader, it is quite easy to rack up this amount of commission actually. You can see that just from a day itself on last Friday, 21st of Feb, I've already racked up like almost $5 in terms of commission. Yeah, so definitely Interactive Broker, it also depends whether or not you are an active trader. Yeah. And these are just some of my other trades. AMD, I was holding a diagonal spread on it since the start of the year and have profited quite a lot. But from the recent correction that it has encountered, I've closed it already. And then also started a put option on it. Yes, so this is the chart for AMD. And I'm hoping it could retest the 50-day moving average and then consider another trade. Consider to structure another trade for it. Yeah. So you can see this is the Fibonacci retracement tool. And these levels are now acting as a potential support, a tendency for the stock to find strong support at these levels over here. Could the 20 EMA be one? Likely, but let's see. Since I have a put option on it, I'm bearish on it and I hope that it will correct as much as possible before rebounding again. Yes. Okay. So if nothing else, then we'll call it a day. All right. Thanks you guys for tuning in to our first ever interactive session for on growing wealth. And yeah, we hope to see you in my future videos. Thank you and have a good night. Bye.